Nothing had collapsed. That was the strange part. Daniel stood at the kitchen window, coffee cooling untouched in his hand, watching the city wake up. Cars moved, lights turned on. The same bakery across the street opened its doors at exactly 6:30 a.m., like it always did. People lined up. The economy, at least on the surface, was still breathing. And yet, for weeks now, Daniel had carried the unmistakable feeling that something was wrong. Not broken, not falling apart, just stretched. Like a bridge holding too much weight, not enough to snap, but enough to make every bolt groan quietly under pressure. Daniel worked as a financial analyst. That was his job title, at least. In reality, he spent his days staring at charts that refused to tell a coherent story. Employment numbers looked solid, markets hovered near record highs, consumer spending hadn't collapsed, inflation had cooled just enough to reassure people. On paper, everything still worked, but paper lies politely. What the charts didn't show was the tension, the way numbers were being held together by assumptions instead of fundamentals. The way confidence, not stability, had become the glue keeping the system upright. Daniel felt it in meetings. He felt it in conversations with friends. He felt it when people talked about money, not with optimism, but with a rehearsed calm, as if everyone had silently agreed not to panic first. He took a sip of his coffee. Cold now, bitter. The strangest systems he had learned were the ones that didn't fail loudly. They failed quietly, slowly, invisibly. They didn't collapse outwardly. They hollowed out from the inside. The illusion of stability. At work, Daniel's manager liked to repeat the same phrase during presentations. The fundamentals are strong. It sounded reassuring, responsible, adult. But Daniel had begun to notice how often that phrase appeared precisely when fundamentals were anything but strong. Strong compared to what? Compared to collapse? Compared to panic? If survival was the benchmark, then yes, things were strong. But survival wasn't the same as health. A body could survive years of neglect. So could an economy. Daniel remembered something his father once said during a recession years ago. Things don't break when they're weak, his father had said. They break when they've been pretending to be strong for too long. Back then, Daniel hadn't understood. Now, he did. Systems learned how to delay pain. Governments printed money. Central banks adjusted interest rates. Corporations restructured debt. Individuals rolled balances forward. Everyone borrowed time. And time, Daniel realized, was the most dangerous debt of all. Why nothing has collapsed. Yet Daniel pulled up his laptop and scanned the morning headlines. Markets open flat. Jobs report beats expectations. Consumers show resilience. Resilience. That word again. Resilience implied pressure. It implied strain. It implied something pushing back hard enough that survival itself had become newsworthy. He thought about how often people confused resilience with sustainability. Just because something could endure stress didn't mean it should. A rubber band stretched far enough would still look intact, right until the moment it snapped. The global economy, Daniel believed, was a rubber band stretched across decades of shortcuts. Debt had replaced savings. Growth had replaced stability. Confidence had replaced truth. And yet it still worked. Why? Because systems didn't run on logic alone. They ran on belief. People believed their money would hold value. They believed banks would remain solvent. They believed governments would intervene if things went wrong. Belief was cheaper than reform, easier than restructuring, faster than discipline. As long as belief held, the system held. Daniel closed his laptop. Belief, however, was fragile. The personal mirror. What unsettled Daniel most was how familiar this pattern felt, because his own life looked the same. From the outside, Daniel was doing fine. He had a stable job, a clean apartment, a decent savings account, no visible crisis, no dramatic failure. Friends assumed he was secure, comfortable, ahead. But inside, the structure was thinner than it appeared. His savings existed, yes, but they were stagnant. His income covered his expenses, but only barely once lifestyle inflation crept in. His retirement plan depended heavily on assumptions about markets that he no longer fully trusted. He wasn't drowning, but he wasn't swimming either. He was floating. And floating, he realized, wasn't a strategy. Just like the economy, his life worked until it didn't. The cost of delayed collapse. Daniel remembered studying financial crises in college. Every one of them had warning signs. Every one of them had people saying, "This can't last." And every time someone else responded, "But it's lasted this long." Longevity was used as proof of safety. It wasn't. It was proof of tolerance. The longer a system avoided collapse, the more confident people became that collapse wouldn't come. That confidence encouraged risk. Risk increased leverage. Leverage magnified fragility. Eventually, even small shocks became catastrophic. Daniel saw it now everywhere. People delayed saving because things were okay. They delayed paying down debt because rates might go down. They delayed changing careers because this job still pays, still works, still standing. The word "still" was doing a lot of heavy lifting. Invisible supports. One of the reasons collapse hadn't come, Daniel knew, was intervention. Central banks stood ready. Governments had tools. Policies existed precisely to stop free fall. The system was padded, guard-railed, propped up. But supports weren't foundations. They didn't make structures stronger. They just kept them upright longer. And the longer something stood artificially, the more damage accumulated beneath the surface. Daniel thought about buildings held up by temporary scaffolding. No one worried until the scaffolding became permanent. What happened when the supports were removed? Or worse, when they failed? The quiet agreement. Daniel noticed another pattern. No one talked openly about how fragile things felt. Conversations stayed shallow, optimistic, carefully neutral. Talking about risk made people uncomfortable. Talking about collapse made them defensive. Talking about preparation made them seem paranoid. So everyone stayed quiet. A quiet agreement formed. Don't rock the boat. Don't be the first to panic. Don't say what everyone else is thinking. This silence, Daniel realized, was not ignorance. It was denial. And denial, more than debt or inflation or policy mistakes, was the real danger. Because systems didn't collapse when everyone saw the problem. They collapsed when no one acted because acknowledging the problem felt worse than ignoring it. The question that wouldn't leave. That night, Daniel lay awake staring at the ceiling. The city outside hummed softly. Life continued. He couldn't stop thinking about one question. If everything still works, why does it feel like it's barely holding together? The question applied to markets, to governments, to companies, to relationships, to his own finances. It applied to everything built on momentum instead of intention. Daniel understood now. Collapse wasn't a moment. It was a process. A slow erosion disguised as stability, and the most dangerous time wasn't after collapse. It was before it, when everything still looked normal. What comes next? Daniel didn't know when or if the economy would truly break. What he did know was this. Waiting for collapse to force change was the most expensive strategy imaginable. Systems that survived did so not because they avoided pressure, but because someone chose to reinforce them before failure became inevitable. That realization settled heavily in his chest. Because if the economy could survive this long while being this fragile, what about his own life? And more importantly, what was he doing to strengthen it before something broke? Perfeito. Aqui está o episódio 5, parte 2, mantendo o mesmo tom, ritmo de documentário narrativo e já expandindo a base conceitual para sustentar o episódio completo com folga acima de 11.200 palavras. Episódio 5, Parte 2. Target, per 1.400 Indian 400 words. The pillars holding the system upright were invisible. That was the problem. Daniel didn't realize it immediately. For years, he had been trained to look for visible forces. Interest rates, GDP growth, inflation, employment numbers. Those were the metrics everyone watched. The numbers that flashed across screens. The figures debated endlessly on television. But the economy, he was beginning to understand, was not held together by numbers alone. It was held together by belief. The first pillar. Confidence. Confidence was not optimism. Daniel had learned that the hard way. Optimism was hope. Confidence was assumption. People didn't wake up each morning thinking, I hope the system works today. They woke up assuming it would. They assumed their money would still buy groceries. They assumed their paycheck would clear. They assumed their bank would open its doors. Confidence was silent, invisible, unquestioned. And because it was unspoken, it was rarely protected. Daniel remembered the first time he truly noticed confidence wobble. It wasn't during a crash. It wasn't during a recession. It was during a completely normal week when a rumor spread, nothing confirmed, nothing proven, that a regional bank was under stress. Lines formed by noon, not because people knew something was wrong, but because they feared being the last to react. Confidence didn't disappear gradually. It vanished all at once. The system didn't fail when money ran out. It failed when trust did. Why belief is stronger than fundamentals. Daniel pulled an old notebook from his desk drawer, flipping through pages of handwritten notes from years ago. One sentence stood out. Markets are stories people agree to believe. At the time, he had dismissed it as academic poetry. Now it felt painfully accurate. Every economic system was built on shared assumptions, that growth would continue, that rules would remain stable, that tomorrow would resemble today closely enough to plan for it. As long as enough people believed those assumptions, the system functioned, even if the underlying reality had shifted. That explained why warning signs could be visible for years without triggering collapse. Reality bent, belief didn't, until it did. The second pillar, incentives. If confidence was the emotional glue, incentives were the mechanical force. Daniel saw it everywhere once he started looking. Politicians were incentivized to delay pain. Corporations were incentivized to maximize short-term returns. Banks were incentivized to lend. Consumers were incentivized to spend. No one was incentivized to slow down. Stability rarely won elections. Prudence rarely boosted stock prices. Caution rarely went viral. The system rewarded momentum, so momentum became policy. Debt expanded not because people were reckless, but because debt was rewarded. Spending rose not because people were irresponsible, but because restraint was punished. If Daniel stopped investing aggressively, his portfolio lagged. If a company stopped expanding, investors fled. If a government cut spending, approval ratings dropped. Incentives didn't require malice to cause harm. They only required alignment. And right now, everything aligned toward delay. The third pillar, narrative. Every era had a story it told itself. Daniel could list them by decade. This time is different. We've learned from the past. The system is more resilient now. Technology has changed the rules. These narratives weren't lies. They were partial truths. And partial truths were far more dangerous than lies because they allowed people to feel informed while remaining exposed. The narrative of the moment was resilience. The economy was resilient. Consumers were resilient. Markets were resilient. Resilience became a shield against deeper questions. Resilient to what? At what cost? For how long? Daniel noticed how rarely those questions were asked. Narratives weren't designed to answer questions, they were designed to quiet them. The fourth pillar, complexity. Complexity protected fragility. The more complicated the system became, the harder it was for anyone to understand it fully. Responsibility diffused, accountability blurred. When something went wrong, no single person could be blamed. It's complicated, people said. And they were right, but complexity didn't eliminate risk. It hid it. Daniel thought about financial products layered on top of other financial products, derivatives referencing derivatives, algorithms trading against algorithms. Speed increased. Transparency vanished. The system looked sophisticated. It was, in reality, brittle. Simple systems failed loudly and early. Complex systems failed silently and catastrophically. The personal reflection returns. Daniel couldn't ignore how closely these pillars mirrored his own behavior. Confidence. He assumed his job would remain secure. Incentives. He chased promotions that came with stress, but not fulfillment. Narrative. He told himself he was on track. Complexity. He avoided fully understanding his finances because they felt overwhelming. His life worked because belief held. But belief was not the same as preparedness. He had optimized for continuity, not resilience. And suddenly, the word resilience felt hollow. True resilience, Daniel realized, wasn't about enduring pressure. It was about reducing dependence on fragile systems. The illusion of control. Daniel remembered a phrase often repeated in finance. The system is under control. But control was another illusion. No one controlled the system. They influenced it temporarily. Policies were reactions, markets were reactions, decisions were layered responses to previous decisions. Control implied foresight. The system operated on hindsight. Every safeguard existed because something had already gone wrong before. Daniel wondered how many safeguards were missing simply because the failure hadn't happened yet. Why collapse rarely announces itself. People expected collapse to be dramatic, headlines, sirens, sudden stops. But history suggested otherwise. Most collapses were boring until they weren't. They unfolded as fatigue, as erosion, as loss of margin. Things didn't break, they thinned. Savings thinned, patience thinned, trust thinned. By the time collapse became visible, it had already happened internally. Daniel felt a chill run through him. If that was true, then the most dangerous moment wasn't the crash. It was right now, a subtle shift. Daniel made a decision that night. Not a dramatic one, not a radical one, a subtle one. He stopped asking, will the system hold? And started asking, what happens if it doesn't? That question changed everything. It shifted his focus from prediction to preparation. From optimism to agency. He began to see that financial security wasn't about timing markets or guessing collapses. It was about reducing exposure to assumptions you couldn't control. The uncomfortable truth. The truth Daniel couldn't escape was this. The economy hadn't collapsed because too many people depended on it not collapsing. And that dependence was the very thing making it fragile. The longer the system survived without reform, the more painful reform would become. The longer individuals delayed strengthening their foundations, the fewer options they'd have when pressure finally arrived. Collapse, Daniel realized, was not inevitable, but neither was stability. What mattered was whether people prepared while things still appeared normal. Looking ahead, Daniel closed his notebook and leaned back in his chair. Part of him wished the economy would just break already, cleanly, honestly, so the pretending could stop. But another part understood the danger in that wish, because collapse didn't reset lives evenly. It punished the unprepared, and Daniel no longer wanted to be one of them. He didn't need the system to fail to take responsibility. He just needed to stop mistaking survival for strength. Perfeito. Seguimos mantendo ritmo, profundidade e expansão real. Aqui está o episódio 5, parte 3, já empurrando o episódio com conforto rumo às 11.200 plus palavras, sem repetição nem enchimento artificial. Episódio 5, parte 3, target 1.400-1.500 words. The cost of fragility was not measured in numbers. That was the mistake most people made. Daniel used to think risk lived inside charts, volatility percentages, debt ratios, yield curves bending in ominous shapes. But the deeper he went, the clearer it became that fragility expressed itself first in human behavior. Before systems failed, people changed, quietly. The slow behavioral shift. Daniel noticed it in small moments. A colleague who used to talk about long-term goals now spoke only about quarterly bonuses. A friend who once dreamed of starting a business postponed it until things feel more stable. A couple he knew delayed having children, not because they didn't want them, but because uncertainty felt heavier than desire. No one said, "I'm afraid the system won't hold." They said things like, "Now's not the right time. Let's wait and see. Better to be cautious." Caution sounded wise, responsible, mature. But Daniel sensed something underneath it. This wasn't strategic caution. It was defensive hesitation. People weren't choosing their future, they were postponing it. When time becomes the hidden cost, fragile systems extracted payment not all at once, but over time. Deferred decisions, compressed dreams, shrinking horizons. Daniel thought about how many lives were quietly shaped by economic uncertainty, not through dramatic loss, but through absence. The business never started, the move never made, the investment never taken, the risk never allowed. On paper, nothing went wrong, but potential evaporated. And unlike money, potential rarely came back. Why fear rarely looks like panic? Fear, Daniel realized, didn't usually scream. It whispered. It disguised itself as practicality. Fear said, "Stick with what you know. Don't rock the boat. This is good enough." And because the system still functioned, fear didn't feel irrational. It felt justified. That was the most dangerous part. When fear aligned with circumstances, it became invisible. People didn't think they were afraid. They thought they were being smart. The shrinking margin of error. Daniel opened a spreadsheet and began mapping something new. Not markets, but margins. How much buffer did people really have? Savings rates were thin. Emergency funds were shallow. Debt payments consumed flexibility. Most lives ran efficiently, too efficiently. Efficiency eliminated slack. Slack absorbed shock. Without slack, even small disruptions became crises. A missed paycheck, a medical bill, an unexpected expense, nothing catastrophic on its own. But with no margin, everything felt catastrophic. Daniel understood now why anxiety had become so common, even among people who were doing fine. They weren't anxious because things were bad. They were anxious because things were tight. Tight systems feel calm until they don't. Tight systems performed well under normal conditions. They optimized resources, reduced waste, maximized output. But tight systems had one fatal flaw. They couldn't bend. A bridge with no flexibility didn't sway in the wind. It cracked. The economy felt tight. Households felt tight. Daniel felt it in himself. His calendar was full, his budget was balanced, his life was optimized. And yet there was no room to breathe, no room to fail safely, no room to experiment. Everything had to go right. The psychological toll of everything must work. Living in a system where everything must work created a specific kind of stress. Not loud panic, constant vigilance. People monitored expenses obsessively. They checked balances compulsively. They worried about decisions they hadn't even made yet. The future became something to manage, not imagine. Daniel recognized the signs in himself. He no longer asked, "What do I want?" He asked, What can I afford to want? That shift seemed subtle. It wasn't. It marked the moment imagination surrendered to constraint. Why fragile systems breed control. When uncertainty increased, people tried to control what they could. They micromanaged budgets, they optimized routines, they planned obsessively. Control provided relief, but control was not the same as security. In fact, the more people tried to control outcomes, the more anxious they became, because deep down, they knew how little they truly controlled. Markets, employers, policies, crises. Most of life happened outside the spreadsheet, the paradox of preparation. Daniel noticed a paradox. The people most at risk often prepared the least. Not because they were irresponsible, but because preparation required acknowledging vulnerability. And acknowledging vulnerability felt frightening. It felt like admitting weakness. So instead, people doubled down on hope. Hope that nothing would go wrong. Hope that systems would hold. Hope that tomorrow would look like today. Hope was easier than action. But hope, Daniel knew, was not a strategy, though the quiet trade-off. Every delay came with a trade-off. When people delayed saving, they traded future freedom for present comfort. When they delayed learning, they traded clarity for convenience. When they delayed change, they traded possibility for familiarity. None of these trades felt dramatic. They accumulated silently. Years later, people wondered why their lives felt smaller than expected. The answer was rarely a single bad decision. It was 1,000 small ones made under the weight of uncertainty. Daniel's breaking point. One evening, Daniel sat alone in his apartment, staring at the glow of his phone. Another alert, another headline, another expert explaining why everything was fine or why everything was doomed. He felt tired, not physically, existentially, tired of reacting, tired of waiting, tired of living inside someone else's assumptions. That's when the thought hit him, clear and uncomfortable. If the system's fragility is shaping my decisions, then I'm already paying the price. Collapse didn't need to happen to cost him something. It already was. A different question. Daniel stood up and walked to the window. The city still moved, still worked, still functioned, but he no longer mistook movement for progress. He asked himself a different question now. If stability is temporary, what lasts? The answer didn't come immediately, but he sensed it wouldn't be found in predictions or headlines. It would be found in structure, in habits, in buffers, in choices that reduce dependence on fragile systems, not escape from the system, resilience within it. What fragility teaches, if you listen. Fragile systems taught lessons quietly, long before they broke. They taught the cost of waiting. They taught the danger of comfort without margin. They taught that fine was often the warning sign. Daniel realized that people who thrived in uncertain systems weren't the smartest or the luckiest. They were the ones who built slack when others chased efficiency. They moved slowly when others rushed. They prepared quietly when others celebrated. They acted before fear forced their hand. The shift begins. Daniel didn't change everything overnight. He changed one thing. He stopped optimizing for outcomes and started optimizing for optionality. He wanted room to choose, room to adapt, room to breathe. The economy might hold, or it might not. But his life no longer needed to be balanced on that assumption. Every system had one shared instinct: delay the pain. Daniel saw it everywhere once he knew how to look. Governments postponed difficult reforms. Companies refinanced instead of restructuring. Households rolled balances forward, telling themselves they'd deal with it later. Later became a strategy, and delay became doctrine. Why delaying pain feels rational. Delaying pain wasn't stupidity, it was survival logic. Pain disrupted routines, pain triggered backlash, pain forced accountability, so systems evolved to absorb it temporarily. Borrow now, refinance later, print liquidity, extend timelines. Each decision bought time, and time, everyone agreed, was valuable. But Daniel noticed something critical. Time was never neutral. It always came with interest. The interest on delay. When pain was delayed, it didn't disappear. It compounded. Deferred maintenance became structural damage. Deferred savings became dependency. Deferred decisions became lost options. The bill always arrived larger than expected. Daniel thought about infrastructure. Bridges repaired just enough to remain standing, roads patched instead of rebuilt. They worked until they didn't, and when they failed, the cost wasn't just financial, it was trust. Markets and the art of postponement markets were masters of delay. Losses were smoothed, volatility was absorbed, failures were socialized, crises didn't vanish, they were redistributed, forward in time, outward across participants. Daniel understood now why markets could stay irrational longer than individuals could stay solvent. The system had more capacity to postpone consequences than any single person. But that didn't make it safe. It made it deceptive. Why stability becomes addictive. Stability felt good. It lulled people into assuming continuity. Each year without collapse strengthened the belief that collapse wouldn't come. Risk felt theoretical. Preparation felt unnecessary. Daniel remembered how often he'd thought, if nothing bad has happened yet, why worry now? But that logic only worked in hindsight. By the time worry felt justified, options were limited. The illusion of infinite extensions were seductive. Loan extensions, policy extensions, emergency measures extended again and again. Temporary solutions became permanent features. No one wanted to be the one who pulled support. No one wanted to trigger the correction. Because corrections were messy, they exposed weaknesses. They forced trade-offs. They created winners and losers. Delay avoided those conversations for a while. The human version of delay. Daniel recognized the same behavior in people's lives. They delayed difficult conversations. They delayed career changes. They delayed confronting financial reality. They told themselves they were waiting for clarity. In truth, they were waiting for certainty. And certainty rarely arrived. Why? Systems reward. Waiting until they don't. The system rewarded those who waited, those who stayed invested, those who stayed leveraged, those who stayed exposed. For years, waiting paid. People who exited early missed gains. People who reduced risk lagged behind. People who prepared looked paranoid. Preparation carried opportunity cost until it didn't. Daniel saw how cruel that dynamic was. It trained people to ignore risk, right up until risk became unavoidable. The moment delay stops. Working delay failed when pressure exceeded capacity. Not all at once. First, flexibility vanished, then buffers disappeared, then trust eroded. By the time collapse became visible, the system had already lost its ability to respond. Everything became urgent. Everything became reactive. That was when bad decisions multiplied. Why pain is less dangerous than suppression. Daniel came to an uncomfortable conclusion. Pain, when faced early, was manageable. Pain, when suppressed, was catastrophic. Early pain forced adaptation. Suppressed pain demanded sacrifice. Small corrections preserved optionality. Delayed corrections destroyed it. The system feared pain. But pain was feedback. Ignoring feedback never ended well. The cost of artificial calm. Artificial calm required constant intervention, liquidity injections, policy assurances, narratives of control. As long as interventions continued, calm remained. But the system grew dependent, removed support and instability surged. Daniel compared it to medication, helpful in emergencies, dangerous when permanent. What individuals often mistook system-level stability for personal security. They assumed, if the system is fine, I'm fine. But the system optimized for averages. Individuals lived in specifics. Averages didn't pay rent. Averages didn't cover emergencies. Averages didn't protect against job loss. Daniel realized that many people were exposed even while the system appeared stable. The calm wasn't shared equally. The question. No one wanted to ask. The question was simple. What happens when delaying pain becomes impossible? No one wanted to answer it, because the answer implied responsibility. It implied that choices made years ago still mattered. It implied that rescue wouldn't be universal. Daniel's shift in perspective. Daniel stopped trying to predict when delay would end. He focused instead on reducing how much it mattered if it did. He didn't need collapse to validate preparation. He needed resilience, regardless of outcomes. That meant lower fixed costs, greater liquidity, fewer assumptions. It wasn't pessimism, it was freedom. The quiet advantage of acting early. Acting early didn't feel heroic. It felt lonely. There were no headlines for restraint, no applause for buffers, no recognition for caution. But Daniel felt something new. Space. Space to choose. Space to respond. Space to breathe. The system might continue delaying pain, or it might not. But his life no longer depended on the timing. The lesson of delay was not neutral. It shaped behavior. It trained dependency. It punished readiness. Understanding that changed how Daniel saw everything, from markets to governments to himself. Breakpoints were never announced. They didn't arrive with sirens or countdowns. There was no single moment when someone stood up and said, "This is it." Breakpoints arrived quietly, when multiple pressures converged at once. Daniel had spent months trying to identify the trigger, the event, the catalyst, the thing everyone would point to later and say, "That's when it started." He eventually realized he was asking the wrong question. Systems didn't break because of one force. They broke when several tolerable stresses became intolerable together. The collision point belief, incentives, delay, each could exist on its own without catastrophe. Belief kept people calm. Incentives kept systems moving. Delay kept pain manageable. But when all three collided, the system entered a dangerous zone. Belief prevented early action. Incentives discouraged restraint. Delay compressed future choices. By the time pressure surfaced, flexibility was gone. Daniel began calling it the collision point, the moment when the system no longer had room to maneuver, but everyone still acted as if it did. Why warning signs are always dismissed. Daniel reviewed past crises with a colder eye. The warnings were always there. Debt levels flagged as unsustainable. Asset prices disconnected from fundamentals. Productivity lagging behind expectations. And yet, nothing happened. Not because the warnings were wrong, but because acting on them was costly. Acting early meant slower growth, political backlash, lower returns. Ignoring them meant comfort. So the system learned to reinterpret warnings as noise. Experts became alarmists. Caution became pessimism. Preparation became overreaction. Daniel saw how narratives adjusted to protect inaction. The moment incentives flip. The most dangerous phase wasn't when incentives pushed risk-taking. It was when incentives suddenly flipped, when liquidity tightened, when rates rose, when margins disappeared. Suddenly, behaviors that were rewarded became punished. Leverage that amplified gains amplified losses. Growth that masked inefficiency exposed fragility. Speed that once created advantage created mistakes. The system didn't slow gradually, it lurched, and people who had optimized for the old rules found themselves trapped by them. Why people are always late? Daniel noticed a painful truth. Most people reacted only when consequences became personal. Headlines weren't enough, charts weren't enough, warnings weren't enough. Action required impact, a job loss, a portfolio drop, a missed payment. By then, options narrowed. It wasn't ignorance that made people late. It was human nature. We respond to pain, not probability. The emotional shock of rule changes. When systems crossed the collision point, the rules changed abruptly. What worked yesterday stopped working today. Cash became scarce, credit tightened, patience vanished. People who felt competent suddenly felt confused. Daniel remembered reading stories from past downturns. People said things like, "I did everything right. I followed the rules. I don't understand how this happened." They weren't lying. They were following rules that no longer applied. Why stability creates overconfidence. Long periods of stability created overconfidence. People extrapolated calm indefinitely. Risk models adjusted downward. Buffers were reduced. Contingency plans faded. Daniel realized stability didn't teach resilience. It taught expectation. And expectation was brittle. The first real signs. The earliest signs of collision weren't crashes. They were frictions. Hiring slowed. Projects paused. Credit approvals tightened. Conversations changed. People stopped talking about growth and started talking about runway. But the tone shifted before the numbers did. Daniel learned to listen for that shift. Why systems freeze before they fall. As pressure mounted, systems froze. Decision makers hesitated. Institutions waited for clarity. Individuals postponed action. Everyone looked at everyone else. Who would move first? Who would admit the problem? Who would absorb the blame? Freeze felt safer than motion, but freeze was fatal. The human cost of the freeze. During the freeze, uncertainty peaked. People didn't know what to do, but knew something was wrong. That limbo was worse than collapse. At least collapse clarified reality. Freeze prolonged anxiety. Daniel thought about how many people lived months or years inside that uncertainty. Jobs felt insecure. Savings felt insufficient. The future felt opaque. Life decisions stalled. Why preparedness feels invisible. Prepared people didn't look heroic during collapse. They looked boring. They didn't panic. They didn't rush. They didn't react emotionally. And because they didn't suffer visibly, their preparation went unnoticed. Daniel realized preparedness rarely earned admiration. It simply prevented regret. What Daniel understood, too late. Daniel wished he had understood earlier that systems didn't protect individuals. They optimized outcomes. If you fit the model, you were fine. If you didn't, you were exposed. Personal resilience mattered more than systemic promises. The internal shift completes. Daniel no longer waited for confirmation. He accepted uncertainty as permanent. Instead of asking, "Is this going to get worse?" he asked, "Am I positioned to adapt if it does?" That question stripped away drama. It turned fear into design, designing for collision. Designing for collision didn't mean predicting disaster. It meant assuming stress would arrive eventually. And that assumption changed everything. Lower fixed commitments, higher liquidity, fewer dependencies, less optimization, more margin, the calm. After understanding didn't make Daniel pessimistic, it made him calm. Calm came from knowing he wouldn't be forced into decisions by timing he couldn't control. The system might collide, or it might not. Either way, he would move on his terms. Looking forward, Daniel sensed the episode was turning. The question was no longer what could break. It was how individuals could quietly outgrow fragility, even inside an unstable system. That answer wouldn't come from headlines. It would come from habits, from structure, from choices made before pressure demanded them. Perfeito! Entramos agora na virada mais prática e pessoal do episódio. Aqui está o episódio 5, parte 6, mantendo o tom narrativo e aprofundando como o indivíduo reconstrói margem e autonomia, sem virar manual ou autoajuda. Episode 5. Part 6, target, this one 400, use 500 words. Rebuilding margin didn't start with money. That was the first surprise. Daniel assumed resilience would come from numbers, larger balances, better allocations, safer assets. But when he looked closer, he realized margin began somewhere quieter. It began with permission. Permission to slow down, permission to step back, permission to stop reacting. Most people never gave themselves that permission. They stayed busy because busyness felt productive. They stayed exposed because exposure felt normal. Daniel decided to do the opposite. The first margin is mental. Before changing his finances, Daniel changed his pace. He stopped consuming economic news compulsively. He reduced the noise that demanded constant reaction. This wasn't ignorance, it was insulation. He realized how much anxiety came from being mentally over-leveraged. Too many inputs, too many opinions, too many forecasts competing for attention. Margin required clarity. Clarity required space. Why optionality beats optimization. Daniel had spent years optimizing. Optimizing returns, optimizing schedules, optimizing outcomes. Optimization assumed stable conditions. Optionality assumed change. Optionality meant choices. It meant being able to say no. It meant being able to wait. It meant being able to pivot without panic. Optimization maximized today. Optionality protected tomorrow. Daniel chose optionality. Financial margin is boring. And that's the point. Financial margin didn't look impressive. It wasn't aggressive. It wasn't exciting. It didn't win arguments online. It was boring. Lower fixed expenses, more liquidity than necessary, less dependence on timing. Friends asked why he wasn't putting his money to work. Daniel understood the question. Idle resources looked inefficient. But inefficiency was exactly what created resilience. Why liquidity is psychological power. Liquidity wasn't just financial, it was emotional. Knowing he could absorb surprises changed how Daniel experienced daily life. Decisions felt lighter, risks felt optional, pressure felt reduced. Liquidity didn't make him richer overnight. It made him calmer immediately, and calm improved judgment. Reclaiming time margin. Daniel noticed another constraint: time. His calendar was full, not with essentials, but with obligations that accumulated over years. Commitments made in easier times, projects started without exit plans, responsibilities inherited by default. Time margin mattered as much as financial margin. Without it, everything felt urgent. Daniel began pruning, not dramatically, quietly. The power of fewer dependencies. Dependencies multiplied fragility. One income source, one employer, one skill set, one assumption. Daniel didn't try to eliminate dependence, he diversified it. Side projects, transferable skills, broader networks. Nothing flashy, just redundancy. Redundancy wasn't waste, it was insurance. Why small buffers matter more than big bets. Daniel stopped looking for big moves. He focused on buffers. A few extra months of runway, slightly lower lifestyle costs, extra capacity in his schedule. These changes didn't transform his life, they stabilized it. And stability created leverage over time. The shift from reaction to design. Before, Daniel reacted to headlines, to incentives, to fear. Now he designed. He asked, what decisions reduce forced outcomes? What choices expand future options? What assumptions am I relying on without noticing? Design replaced prediction, and design proved more reliable. Why most people don't build margin? Daniel understood why most people didn't do this. Margin felt unnecessary when things worked. It felt wasteful when resources were scarce. It felt lonely when others optimized aggressively. Building margin required going against momentum. It required acting before necessity demanded it. That felt uncomfortable. The emotional cost of living without margin. Without margin, life became reactive. Every expense mattered too much. Every decision felt final. Every risk felt dangerous. People weren't weak, they were constrained. Daniel saw that clearly now, and he stopped judging others. He focused inward. What changed first? The first change wasn't financial metrics, it was posture. Daniel stopped leaning forward anxiously. He leaned back. That posture shift affected everything. Negotiations felt different. Decisions felt clearer. Fear lost urgency. Margin created leverage, even without power. Resilience isn't escape. Daniel didn't leave the system. He still worked, still invested, still participated. But he wasn't dependent on it behaving perfectly. That distinction mattered. He could stay calm when others panicked. He could wait when others rushed. Not because he was smarter, because he had room. Why calm becomes a competitive advantage. Calm allowed patience. Patience allowed better timing. Better timing improved outcomes. While others reacted emotionally, Daniel responded deliberately, not always correctly, but never forced. That alone changed his trajectory. The subtle confidence of margin didn't announce itself. It didn't broadcast success, but it showed up in quiet ways, saying no without explanation, walking away from bad deals, waiting when others demanded action. Confidence wasn't loud, it was stable. The system didn't change. The economy didn't collapse, markets didn't implode, life went on. And that was the point. Daniel didn't build margin because collapse was guaranteed. He built it because fragility was expensive, even without collapse. Looking ahead, as Daniel stood back and surveyed his life, he noticed something unexpected. The future felt open again, not certain, but open. That openness was the real return on margin, and it set the stage for the final realization still ahead. Once Daniel stopped outsourcing his future, he noticed something unsettling. Most of what he had been chasing wasn't security, it was approval. Approval from systems that didn't know him, approval from metrics that didn't care about context, approval from narratives designed to keep him participating. Success, as it turned out, was a social agreement, and agreements could be rewritten. How systems define success for you? The system offered a template: work steadily, climb predictably, consume responsibly, retire eventually. Those who followed the template were labeled disciplined. Those who deviated were labeled risky. But the template assumed stability. It assumed linearity. It assumed the future would resemble the past. Daniel realized that many people weren't pursuing their own version of success. They were renting one. The hidden cost of renting success. Rented success came with conditions. Stay employed, stay compliant, stay invested. Miss a payment, financial or behavioral, and access was revoked. Daniel saw how fragile that arrangement was. Success that depended on uninterrupted system function was conditional. Conditional success created anxiety. Anxiety created compliance. Why safety is often misdefined. Safety was often framed as predictability. Predictable income, predictable career path, predictable outcomes. But predictability depended on assumptions outside individual control. Daniel reframed safety. Safety wasn't predictability. It was adaptability. The ability to absorb change without collapse. The freedom of redefinition. Redefining success was uncomfortable. It meant letting go of comparison. It meant disappointing expectations. It meant standing without validation. But it also meant freedom. Freedom to design a life resilient to shocks. Freedom to choose sufficiency over accumulation. Freedom to value stability over status. Daniel felt lighter. Why outsourcing the future feels comfortable? Outsourcing responsibility felt comforting. If things went wrong, blame could be shared. If things went right, rewards felt deserved. Taking ownership meant accepting uncertainty. It meant acknowledging that no system guaranteed outcomes. That responsibility scared people, but Daniel found it clarifying. The myth of collective protection systems promised protection, insurance, regulation, safety nets. Those protections mattered, but they were not personal. They activated late. They applied broadly. They optimized averages. Daniel understood their limits. They reduced catastrophe, but didn't eliminate risk. Why people confuse? Participation with control. Participation felt like control. Voting, investing, working. But participation didn't equal influence. Influence was asymmetrical. Decisions were made far from where consequences landed. Daniel stopped confusing involvement with agency. Agency was built individually. The quiet power of personal alignment. Alignment changed everything. When Daniel's actions matched his values, friction disappeared. He no longer chased every opportunity. He no longer feared missing out. He no longer needed constant reassurance. Alignment created internal stability, and internal stability reduced external dependence. Why enough is a radical concept. Enough was radical in a system built on growth. Enough income, enough consumption, enough ambition. Defining enough removed the pressure to constantly escalate. It broke the treadmill. Daniel wasn't anti-growth. He was anti-compulsion, the emotional aftermath of redefinition. There was grief in redefining success. Grief for paths not taken. Grief for identities released. Grief for approval forfeited. But there was relief too. Relief from comparison. Relief from urgency, relief from fear of falling behind, how resilience changes relationships. Daniel noticed his relationships shift. Some drifted, some deepened. Conversations changed, less about status, more about meaning, less about timing markets, more about timing life. Resilience attracted a different crowd. Why this isn't about withdrawal. Daniel didn't withdraw from society. He re-engaged selectively. He chose where to depend. He chose where to invest energy. He chose where to say no. Selective participation replaced blind participation, the end of false urgency. False urgency lost its grip. Not everything needed to be done now. Not every opportunity was real. Not every risk required action. Daniel moved slower, and paradoxically, got further. The system continues. The system continued. Markets rose and fell, headlines cycled, narratives evolved. Daniel no longer felt dragged along. He walked beside it, the final reframe. The economy might never collapse, or it might. That question no longer defined Daniel's life. What mattered was this: he had stopped letting fragile systems write his story. Looking toward the end, one part remained: the quiet conclusion. The understanding that resilience wasn't dramatic, it was ordinary, and that was its power. In the end, nothing dramatic happened. That was the most surprising part. There was no collapse that validated Daniel's preparation, no single event that proved him right, no moment of collective realization. The world simply kept moving, and Daniel realized that was the point. The myth of the big moment. Daniel had once believed that clarity arrived through events, a crash, a crisis, a turning point everyone could see, but real change rarely waited for permission. It happened quietly, through accumulation, small decisions made consistently, assumptions questioned privately, structures redesigned without applause. The absence of drama didn't mean the absence of meaning. Why waiting for collapse is a trap. Waiting for collapse outsourced responsibility. It delayed action until fear forced it. It justified inaction as patience. It framed preparation as pessimism. Daniel understood now that collapse wasn't required for fragility to shape lives. Fragility already did, through stress, through hesitation, through narrowed choices. The quiet outcome of resilience. Resilience didn't look like success stories online. It looked like stability. Bills paid without anxiety. Decisions made without urgency. Sleep undisturbed by headlines. Resilience reduced drama. And drama, Daniel learned, was expensive. What Daniel gained? Daniel gained margin, not just financial, emotional, temporal. He could wait. Waiting became power. Why this story isn't a warning. This wasn't a warning story. It wasn't predicting collapse or fear. It was an observation. Systems optimize themselves. Individuals must optimize for themselves. Those two goals often diverge. understanding that divergence changed everything. The system's job versus yours. The system's job was to function. Your job was to live. Those weren't the same thing. The system could survive volatility. Individuals experienced it. Daniel stopped expecting the system to protect him from uncertainty. He protected himself from dependence, the false promise of certainty. Certainty was always an illusion. People didn't want certainty. They wanted relief. Relief from decision-making. Relief from responsibility. Relief from fear. But relief outsourced agency. Agency once reclaimed felt heavier, but truer. What enough finally meant. Enough wasn't a number. It was a feeling. The feeling that choices were available. The feeling that failure wouldn't destroy him. The feeling that life wasn't balanced on perfect conditions. That feeling was worth more than optimization. Why most lessons arrive too late. Most people learned these lessons after loss, after layoffs, after crises, after burnout. Daniel learned them earlier, not because he was smarter, because he paid attention. The ordinary power of boring decisions. The most powerful decisions Daniel made were boring. Spending less than he could, keeping cash he could have invested, saying no when yes felt easier. These decisions compounded quietly, like stability. The system didn't notice. The system didn't notice Daniel's shift. Markets didn't care. Institutions didn't react. Narratives didn't change. That anonymity was freeing. Freedom didn't require permission. Why this applies to everyone. You didn't need to predict the future to benefit from this. You didn't need to believe collapse was coming. You only needed to accept uncertainty. Once uncertainty became permanent, preparation became rational. The final reframe. The economy didn't need to collapse. That was never the point. The point was that fragile systems quietly tax your life, long before they fail. Reducing that tax changed everything. Daniel's last thought. As Daniel looked ahead, he felt something unfamiliar. Confidence without arrogance, calm without denial, hope without illusion. He hadn't escaped the system. He had outgrown his dependence on it. The story ends where it began. This story didn't end with a warning. It ended with an invitation to stop waiting, to stop outsourcing, to start designing, not for certainty, for resilience.